One popular question a lot of traders, a lot of people who are here to get started with crypto or trading has been asking me is that between crypto spot trading and futures trading, which of them is really more profitable, which of them is more risky, and which is easier for beginners to get started with? Well, if you are among those people answering yourself this question, or who have by any means asked me this question on any of my social media platform, then this video is for you. Because in this video, I'm literally going to answer all your questions that has to do with crypto and futures trading, to be able to tell you which one is more profitable, which one is more easier for a beginner to get started, and which one you should go for. Trust me, by the end of this video, you will be able to make a clear decision of which of the trading options is best for you to get started with. So if this sounds like you, hello guys, welcome to Forex Hustle. On this channel, I focus more on crypto and forex. So on here, I only share knowledge about crypto and forex, how you can get started, and how you can also start making profit from it. And in recent time, a lot of people have been asking me about crypto, which trading option will be more profitable for a beginner to get started with, and what is the capital required to get started with any of them. So in this video, I'm set to answer all these questions. So if this sounds like you and you want more great content like this, why not smash that subscribe button, like this video, and tell me what you feel down in the comment section at the very end of this video. So with that already said, let's get started. So the first part of this video is actually knowing what exactly futures trading is and knowing what exactly spot trading is. So now, coming into the definition of these two trading, now let's take the first one, which is spot trading. So if you don't know anything about spot trading is a type of trade whereby it's being traded instantly. Whatever trade you initiate, be it buy or sell, is taken up instantly using the current market price. So that is the idea of spot trading. So whatever thing you're doing in spot trading, it uses the immediate market price to actually initiate the trade for you, so that you get everything you want instantly, which it means by spot. So that is the idea behind. So we all know that spot refers to something that is being done instantly, being caught on spot, meaning instantly. That is the idea behind it. And in the other hand, what is futures trading? So futures trading, as the name says, future. So if you should get rid of the X at the front there, we are directly referring to future. So the definition of futures trading is simply, futures trading is a process of either buying or selling an asset at a predetermined price. So what it means by predetermined price is that when you enter a futures contract today, it doesn't use the immediate market price to either sell or buy the market to you. No, it uses the price that you have evaluated into it, which is a future price that you, the trader, has actually predicted. So in my previous video, I actually entered a futures trade where I was talking about how to get started with futures trading and everything. So if you want to learn more about spot trading and futures trading, do well to watch those videos. They will be linked down in the comment section and also be displayed at the top there. So now coming back, so futures trading is a process of buying or selling an asset in a future time. So whatever you do with futures trading, it happens in the future. Unlike spot trading, that when you take a trade, it happens instantly. And then with futures trading, when you do it, it happens within the predetermined price that you have determined for this system to actually use. So that is about this first part here, which is actually knowing the main difference, the idea behind futures trading and sports trading. Now let's get to the key main things that determine which of them is better, which of them is worse, and which of them you should go with. So let's get in. So now that you've known about their execution process, now let's talk about the other thing. So after executing it, which is how trades are concluded. So now taking sports trading first. When it comes to spot trading, when you trade any pairs together, your final price is determined by the price you are using to either buy or sell. So now here is it. Let me explain it to you. For example, you want to trade Bitcoin against USDT. In this case, we are using Bitcoin as our base currency and the USDT as our quote currency. So for example, you have a USDT in your account worth, let me say $2,000, and then you want to buy Bitcoin because you needed Bitcoin to make a trade or something. So now when you go in there to spot trading to go and buy this Bitcoin of worth $2,000, in spot trading, this Bitcoin will become the final price of your trade will be concluded in Bitcoin, because you are telling the market that, okay, I have USDT and I want to buy Bitcoin, so I'm buying a Bitcoin worth $2,000. So at the end of the trade, your own asset will be in Bitcoin and not in USDT. Hope you are getting it here. So if you trade Bitcoin against US dollar, you are telling the market that you want to buy Bitcoin and this is the amount of money you have, and vice versa also. So if you also have Bitcoin and you need the USDT to make a trade, you can go in there, okay, I have this amount of Bitcoin and I want to sell it for US dollar. So hope you are getting the difference, the clear vision of what spot trading actually is. So in spot trading, when you trade any currency, the base currency becomes your own profit. So your conclusion will be in the base currency other than in the other part of it, which is in futures trading. So now that is it about spot trading ownership of coin, meaning your base currency will become your final pair that you actually hold. Now come over to that of futures trading. With futures trading is totally different, because with futures trading, when you trade a pair, you are actually not owning the base currency as your official pair, because your trade will also be concluded in your quote currency that you used to get started with. So now let me break it down for you. For example, you went into Binance and then you wanted to do a futures trade, and then you initiated a trade that you want to buy Bitcoin. You want to enter a Bitcoin price at a buy market, because we all know that with the futures trading, it's not instant. So it's a predetermined price. So now you are telling the market that, okay, I want to buy Bitcoin worth $2,000 and I'm entering this trade with a $2,000 in my account. So now when you enter this trade and then the trade hits your take profit level, which is where you actually do, your total profit will still not be concluded in Bitcoin. It will be concluded in USDT, because that is the coin you use to enter the trade. Like that is the asset you use to enter the trade. Hope you are getting it here. So unlike spot trading, where if you trade USDT against Bitcoin, your final price will be in Bitcoin. Over here on spot trading, the value you used to trade is what is given to you as your final trade. So for example, you enter a market against, let me say, Bitcoin against Ethereum, and then your main asset you used to start the trading was Bitcoin. Your total profit that you make from that market will also be concluded in Bitcoin and not Ethereum or USDT. But unlike spot trading, if you go in there to buy, whatever thing you are buying becomes your own profit from it. So for example, just like you take your money to the market to go and buy, let me say, any product out there, you want them to buy a Nike shoe. When you give the person the money, the person gives you Nike shoe, right? Then that Nike become what you actually got from the market in spot trading. But over here in futures trading, if you take your money to the market that you want to buy Nike at a certain price, so once you put in the money there, the money stays in there. The person doesn't give you the Nike. It keeps it until when the price of Nike actually hits that value, then it adds it to the profit, then it adds it to your investment, and it gives it as profit. So I hope you are getting there. For example, the price of Nike was $200 in the market, and then you went there that you want to buy Nike, and you give the person your $200. What the person actually does is that he then keeps your $200, you give it to him, and the Nike shoe, and then wait for the price of Nike to actually go up. So once the price of Nike hits that amount called let's say $100 value, then adds to it, which is making it $300. So that $300 now becomes your final profit, meaning you are not getting the Nike shoe you wanted to buy, you are actually getting the price that came up on it. That's simply it. That is it about the Nike. That is about the idea of futures and spot trading, on how which coin that you actually get as your final ownership. Now let's move to the other point of this video, which actually boils down to other key parts that you need to know is. So when it comes over to the trading fee of these two currencies, it's clear that futures trading will automatically have highest fee. Reason is that with futures trading, when you enter the trade, the system manages your trade for quite a long time, which means that more resources are needed for these exchanges to hold your trade, and in that way, your trading fees will be very high. Now, when you come over to spot trading, your trading fee is very less because it's instantly. It's just like doing a trade between two people, and then you have an agency between you and the buyer or the seller. So once you do this trade, since the trade is instantly, it doesn't require much time from the agent between two of you. The fee that the agent is actually going to take from you will be less as compared to someone who is doing a very distance trade, that's have an agent that will be working in between there, like an agent coming and going to make sure that the trade goes successfully. So when it comes to here, in reality, spot trading have the lowest fees as compared to futures trading, no matter the exchange you are using. As long as that exchange does charge you for trade, and they will surely charge you for a trade, futures trading have the highest fee as compared to spot trading. Now that is it about futures trading and spot trading fees. Now let's move over to the other part, which is other key things you need to know to determine which of them is actually profitable, and this way we fall down to volatility between these two markets. Now coming over to volatility between these two markets, between spot trading and futures trading. Now breaking it down, volatility is actually the movement of the market. So in real time, when it comes over to trading, spot trading is more fluctuated as compared to futures trading. Here is why. With spot trading, when you enter the market, you are buying instantly. So your trade is being concluded instantly. Assuming you are trading a $200 Bitcoin in exchange for $200 USDT, the price of the market will be used to make that trade for you. So whatever trade you enter will be sold to you instantly. So when the price moves down, then you make a loss. That is it here. But over here on futures trading, you will not make a loss. Here is the reason. Because in futures trading, when you enter the market, you are predicting a future price, not an instant price. So when you enter the market right now, the market, even when it goes down or goes up, depends on the direction you trade. So for example, let's say you trade a buy market that you want the price to go up so that you can resell again. With futures trading, when you trade such a trade and the market goes against, which is it goes down, you are not making any loss yet, though you have an unrealized loss. But then due to the help of futures trading, which is a long-term trade, your trade will still be open, and then there's still a high probability that the market will come back in your favor again for you to make sale and then get your profit. But for the market to come back into your direction, so you make profit again. Now with spot trading, it doesn't happen like that. With spot trading, the market, once you buy it instantly, it gets sold to you instantly. So assuming one Bitcoin worth $10,000, so you use your $10,000 to buy one Bitcoin. Then after buying, instantly the price of a Bitcoin fell down to $8,000. Now you are at loss because you bought at $10,000 and you are losing at $2,000 already. Now you cannot sell back instantly, and you have to wait for a very long time, which you are not sure if the price will come back above the level you bought it again. That's something you are not sure of. But over here with someone who did spot trading, he doesn't care. Over here with someone who did futures trading, he doesn't care. Once he entered the market with his $10,000, he's telling the market that once this price moves upward, then get me my profit. Once it moves downward, get me out of the trade. So someone who does futures trading is more profitable with the volatility level other than spot trading. So when it comes to volatility, I'll tell you that it's very wrong for if you want to go into spot trading. For volatility, don't try it because it will be really volatile due to the short-term contract as compared to a futures contract, which is a very long-term, meaning there's still a high probability of the market coming back into your favor. So when it comes to volatility, it's a big no for spot trading. Don't worry, at the end of this video, I'm going to list all of them and I'll tell you which one works in which one's favor. Now let's move to the other point in this video, which comes to hedging. So now the next point here is actually what we call hedging. So hedging, when it comes over here now, this one will help you understand what I was referring to in the volatile market in more clear picture. So here is it. When it comes to hedging, hedging is a market process that allows you to take a position and then keep that position for quite a long time. That's one thing hedging does. So now let's take a look at how hedging favors or goes against any of these two trading platforms. So now let's take spot trading first. When it comes to spot trading, you do not have a hedging option because when you go in there to buy, the market is done instantly, meaning whatever trade you get will be done instantly. So you cannot tell the market that, hey, hold this position for me. Like, this is the position I'm holding a buy position. So I don't care how this market goes, as long as I still have funds in my account, let this market go to any direction in which I believe it will come back to my favor again, which doesn't work in spot trading. Because in spot trading, once you say I'm buying, the market gets sold to you instantly. That's it. So for example, let me say you go to the market. Now let's use the Nike as an example here again to help you understand what hedging actually means. So for example, you go to the market and say you want to buy a Nike shoe, or let me say an LG phone. So you went there and they told you that the price of the phone is actually $2,500. Now you who is using the spot trading method, you are paying $2,500 for this phone instantly. Now you get it instantly because you are buying it to go and sell, but then you are not sure if you can sell it instantly to also get your profit again. Now you see hedging becomes a problem here because you cannot tell the shopkeeper that, okay, I want to buy this phone at $2,500. Then when the price gets to $3,000, I want you to sell it and give me back my profit, which doesn't work. But now when it comes to futures trading, you have the opportunity of hedging to always winning back in the market. Here is it. But someone who uses the futures trading mentality will go to the same store now, say he wants to buy that same LG phone which costs $2,500. So when he buys this phone right now, because he is buying to go and sell also, but he's not taking it home in this case, he's telling the phone seller that, okay, I want to buy this phone now that the price is at $2,500. So that once the price hits $3,000, you get my profit out and then give me my $3,000 instead of the $2,500 I give to you. Hope you are understanding it here. With futures trading, since you don't have hedging, the moment you buy the phone gets the phone will be given to you. But without official trading, when you buy the phone will not be given to you instantly. It will be kept for quite a long time till it comes back to any of the things that you've determined how it go, whether you are determined the price will fall down or go up. And that's what will come to our next position, which is the main profitability between these two platforms. So I believe you understand what hedging means. Hedging is simply being able to hold a position for a given time. Meanwhile, spot trading is instantly, so you cannot hold position in spot trading. Now let's move to the other part, which is actually the profitability in these two markets, whether the market is going against you or going. So now let's move to the other part of this video, which actually talks about when the direction the market is going. Because in spot trading, direction matters, but in futures trading, direction don't really matter. Now let's get to what exactly I mean by direction. So now at this point, let's talk about market direction actually. So market direction is actually, we are getting understanding of what a direction is. So a direction is actually a path where something is following. For example, is the market going upwards or is it coming downwards? And we all know that almost everyone hates that market except those who trade futures trading. Don't worry, you are going to understand here. So with futures trading, regardless of the direction the market is going, you can actually make profit, because when you go into futures trading, your market price is actually not concluded in any of the assets you are using to trade. So at the end of the day, either your market is concluded in the USDT price or in the futures price. So let me explain. For example, the price of Bitcoin in the market is at 3,000 US dollar. Now you go into the market to go and analyze, and you see that okay, this market price will actually fall down from $3,000 to 2,005 as a futures trader. So I'm talking about futures trading here. So now after analyzing, you can then enter this market and be like, okay, I have this amount of USDT in my account and I want to trade against Bitcoin, that the price of Bitcoin will fall down to $2,500. And then you enter this market. So the moment you enter this market and this price eventually fall from $3,000 to $2,500, you as a futures trader, you are going to make profit. Because when you enter the market, you have the mindset that the price is going downwards, and you trade that the price will actually go downwards. So what this means is that, so here's how a futures trader actually make profit when the market falls downwards. So you bought this, you entered this market at $3,000 and say it will fall downwards, right? And you have USDT. So what this market is doing for you is that it's helping you acquire imaginary funds at $2,500. So meanwhile, in reality, the market is at $3,000. But with the help of futures trading, the system acquires imaginary funds for you at $2,500. Meaning that it will buy the market for you at $2,500 and then sell at $3,000. That's simply how it works. So when it comes down to futures trader actually makes profit, because you are telling the market that this price will fall down to 2,005 and currently it's at 3,000. So here now, I want to accumulate more at 2,005 so that you sell it to me at the original market price that I entered this market, which was 3,000. So over here, $500 becomes your profit in an exemplary form. Hope you understand how futures trader makes profit now. So as a futures trader, no matter the direction the market is going, you actually makes profit. Now let's talk about spot trading. With spot trading, when the market goes against you, you are out of profit. Here is the reason why. With spot trading, you cannot tell the market that, okay, the current price is at $3,000 and then you want to buy and then take your profit at 2,005 when it falls down. With futures trading, it doesn't work, because when you enter the market, it will sell for you instantly using the market price. That's what spot trading is, because it's executed instantly. So with spot trading, the direction of the market really determines your profit. So if you make a trade at 3,500, the only way you can make profit from this market is to make sure that it goes above that 3,005. When it comes down, you are into loss already. So that's something you need to understand in futures trading and spot trading, unless you do vice versa in it. So what I mean by unless you do vice versa is that, for example, you have a Bitcoin and then you bought this Bitcoin when the market price was at 2,500. Now you have to wait for that price to come and hit 3,000 before you make profit. So with spot trading, only one direction favors you, but in futures trading, both directions favors you. So this one brings it to the conclusion that futures trading is way more profitable than spot trading when it comes to this form of looking at the market. So that this is what the direction plays, and the direction is really important when it comes to crypto or forex trading. So now let's move to other parts that you need to know to help you determine which of them will be best for you. Now let's talk about another key thing when it comes to market. This really skyrockets either your profit or your loss. So now let's talk about it. So now let's look at this point first, which is after this point we'll be moving to the last point, which will really help you close the whole information about trading. So now let's take a look at leverage, market leverage. So in case you don't understand, leverage is actually an extension liquidity that is given to you by this market to help either increase your profit or your loss. So I'll be honest with you, leverage can increase your profit or your loss. So now let's take a look at leverage from a futures trader perspective. So when it comes into futures trading, there's one thing we call leverage, market leverage. So this market leverage is actually an imaginary fund that this exchange actually gives to you to help you make either more profit or more loss during a trade. So for example, as a trader, you have $100 in your account and you want to enter a market that requires a minimum of $1,000. With the help of the market leverage, you can enter this market in futures trading option, because with futures trading, you get up to 120 times your initial funds to help you trade. So for example, if you want to enter a market of $1,000 and you already have $100, what you need is that the market leverage is actually going to give you an additional 10x leverage to multiply the initial amount of money you have, so you'll be able to enter the market. So any profit you make during the trade will be multiplied by 10x. So for example, as you enter the trade with your $100, now that $100 is being multiplied by 10. So if you make a profit of $200, that $200 will now be multiplied by 10. That will give you what? $2,000. That is it, how it works over here. So now with that one, now you get to make more profits with a single trade. And then with this one now, the amount of money you need to enter a trade is also being less, because you don't need high amount of money to either trade again over here in futures trading. But then when you also lose, also your loss will also be multiplied like this. That's why the market always tell you that the higher leverage you use, the higher chance you get liquidated. Because when the market goes against you also, every single move will also be seen as a 10x move against your initial funds. So this is one thing you need to understand about the market. So when it comes over to futures trading, leverage is an opportunity for you to make more profit when you carefully analyze the market and make sure that your options are right. So in general terms, stay with positivity. I would say leverage is an advantage to futures trader other than spot trading, because in spot trading you do not have any form of leverage, because you are limited to only trading the instant market, which will be a limited leverage at your own path. So now this will help you see that futures trading is way more profitable as compared to spot trading, because the only way I see spot trading beating futures trading so far is the only option of trading fee. And trading fee, the higher profit you make, they will take a trading fee, but it's okay because you'll be able to pay that fee off and still keep a more profit in you regardless of the direction the market is actually going to. Now let's take a look at the final part of this video, which will talk about the risks of these two markets and also the easy or difficulty to actually get started with both of these markets. So now let's talk about the risks between these two markets, and I'm going to make this part really brief. So when it comes over to spot and futures trading, I would say the risk between this one, the risk is higher in futures trading, because in futures trading, trust me, because if you are someone who is, let me say you use this leverage, and with futures trading the risk is higher in the sense that for a beginner it won't be easy for you to just get started, because you need to learn a lot of things about the trading market. One is being able to analyze charts to predict where direction is going and the rest, because the risk, generally breaking it down and being honest with you, the risk is higher in futures trading than spot trading. Talking of the easier to get started, spot trading is easy to get started, doesn't require much knowledge, because all you always look out for is the last price the highest price the market has hit, and then the lowest price the market has hit. And with my video about spot trading, which will be linked down in the description and also be in the button at the top there, you'll be able to understand that you can also make more profit with spot trading as long as you are able to take advantage of stop limits and then take advantage of limit trading option, which also not a guaranteed method. So in general, spot trading is less risky, easier to get started than futures trading. Futures trading is difficult to get started and also very risky to get started. And I hope this answers the whole question you have to know about between spot trading and futures trading, which one you should get started with. So with this already said, hope you find this video helpful. If so, don't forget to smash that subscribe button, like this video, and then tell me what you feel
down in the comment section. So have a nice day. Bye.